All right, let's get right into it. In the world of private equity, you've got to think of yourself less as an investor and more as an investigator. And the biggest, most important case you will ever work on is called due diligence. This is really where fortunes are made, or, completely lost, long before a single dollar is ever invested.
So let me just ask you this straight up. How do you spot a billion-dollar lemon before you buy it? How can you tell the difference between a golden opportunity and, well, a really shiny trap? That's the fundamental question we're going to tackle today.
And to get there, we first have to get one thing straight. Due diligence is not some boring administrative checklist. No, it's the single most critical make or break stage of any PE deal. This is where the real action happens. So what is it exactly? Well, at its core, DD is a process of intense, systematic exploration. You're turning over every single stone to truly understand a company's strengths and, maybe even more importantly, its hidden weaknesses. The entire point is to get enough real information to make that one massive decision. Is it a go or is it a no-go?
And this right here, this is the key mindset shift you need to make. See, an audit just verifies that the numbers on a page add up. An investigation, that questions the entire story behind those numbers. You're trying to uncover the whole truth, not just confirm the story the seller wants you to hear.
And what's so crucial to understand is that DD isn't just about avoiding disaster. It's actually the blueprint for success. Every single thing you learn, from how solid the business model is to how good the management team actually is, all of that feeds directly into your first 100 days plan after you buy the company. You're identifying the exact levers you're going to pull to create value from day one. You're not just buying a company, you're buying a plan.
So how does an investigation like this even kick off? Well, it doesn't start with magnifying glass and a trench coat. It starts with paperwork. This is where you gather your first clues and just get a feel for the case.
The process almost always follows these three initial steps. First, you sign an NDA. That's the key that unlocks the door to all the secret stuff. Next, you get the CIM, which is basically the official case file. And finally, you get to the management presentation, your very first chance to question the key players face-to-face. Now, this Confidential Information Memorandum, or CIM for short, this is the company's story, told by them. It's designed by them or their advisors to make the company look as good as possible. It's got the business overview, the financials, the team, and a smart investigator reads it, understands it, and immediately starts wondering, okay, but what are they not telling me?
And that brings us to a really critical moment. When you finally sit down with the management team, are you just listening to their 5-year plan, or are you watching how they talk to each other? How do they handle a really tough question? The truth is, the team dynamics, their confidence, the way they work together, or don't, that can be one of the biggest clues in the entire process.
Okay, so you've done the preliminary work and decided this deal is worth pursuing. Now the real investigation begins. And it's not some random search for clues, it's a super structured deep dive built on 4 distinct pillars. This framework is your investigative toolkit. And these 4 pillars, commercial, financial, legal, and HR, they aren't separate silos. They're all connected. For instance, a big red flag in commercial, like having one customer that makes up 80% of your revenue, that's going to show up in your financial due diligence as a huge risk. A legal problem, like weak IP protection, could completely wipe out your commercial advantage. A weakness in just one of these pillars can bring the whole deal crashing down.
Let's make this real for a second. Take a massive, complex deal like the buyout of Avago Technologies. The commercial due diligence there would have been absolutely everything. You'd be deep in the weeds, mapping out the entire semiconductor market. You'd be asking, is their tech really a competitive advantage? Who are their biggest customers? How much power do their suppliers have? This isn't just academic stuff. This is how you avoid making a multi-billion-dollar mistake. Now for something you won't find in most textbooks. Sometimes, the biggest threat to your investigation isn't a line item on a spreadsheet. It's the psychology of the deal itself. It's a powerful force that can blind even the smartest people in the room.
This quote from Richard Foyston of Navis Capital Partners just nails it. He calls it a conspiracy. Now, he doesn't mean it in a criminal way. He means it in the sense that almost everyone involved is pushing in the exact same direction, towards getting the deal done.
Just look at these 2 opposing forces. On one side, you have this massive wave pushing the deal forward. Your own deal team wants to look good, the lawyers and consultants want their success fees, and the seller obviously wants to sell. It creates this intense momentum, this deal fever. But on the other side,
That's you. Your only duty is to be the unbiased voice, to find the flaws and to protect your investors' money, even if it means being the person who kills the deal everyone is so excited about.
And this creates a very real dilemma, especially when you're starting out. Can you build a career by always being the pessimist in the room? The momentum to say yes is huge. Everyone's excited. And you might be the only one who has to raise your hand and say, hang on a second. It feels risky, but your job, your duty, is to be that skeptical voice of reason.
So, after weeks, maybe months of this intense investigation, after fighting against that deal conspiracy, it all comes down to this. It's time to pull all the evidence together and deliver the final verdict to the people who write the checks. And the way you do that is with a document called the Final Investment Memorandum. This thing is the culmination of all your hard work. It lays out the entire case, the good, the bad, and the ugly from all 4 pillars. It's the document the firm's investment committee uses to give the final green light, or not. So, what do you need to take away from all this for your own career? First, you have to think like a detective, not an auditor. Be skeptical, dig deeper, build your own story, don't just accept the sellers. Second, become a master of all 4 pillars. A great investor sees how a legal risk affects the financial model. And third, and this is maybe the most important, have the guts to say no. Resisting deal fever and knowing when to walk away from a bad deal, that's what separates the good investors from the truly great ones. And I'll just leave you with this final thought to chew on. You've done all the analysis. The spreadsheets look amazing, the market research is solid, the lawyers gave it a thumbs up. But something in your gut, something from all the conversations and experience, it just feels off. Which one do you trust? Answering that question is what will define your entire career in this business.